Good morning, I'm Dylan McNamara.
I'm Kirika Chawla.
I'm Haley Huffines.
I'm Miao Wang.
I'm Nick Stacy.
I'm Alex Obrecht, the Executive Director of the Eastern Economic Association, and my claim to fame is I participated in the High School Fed Challenge in 1996, where my judge told me one day he expected one of us to be in the FOMC room. I don't think he had me judging quite in mind, but...
Good morning. My name is Roy Webb. I'm Senior Economist with the Richmond Fed.
Hi, I'm Stacy Tevlin. I'm the Chief of Macroeconomic Analysis here at the board, and I'm new to this competition, so I'm really looking forward to hearing what you all have to say.
Are you ready? I'll start the clock. Good morning. To begin today's meeting, I believe we should review the most recent economic conditions and policy decisions. As we know, the recession was officially declared over in June 2009 by the NBER. U.S. GDP has been expanding for 5 straight quarters now, with growth as high as 5% annualized. These past 2 quarters, growth rate was 2%. Despite positive economic growth, the unemployment rate as of October 2010 remained well above 9%, indicating significant slack remained in the economy. Broader measures of slack, such as U6, show that there are many underemployed and discouraged workers. Inflation has also become a more significant issue than anticipated. Recently, core PCE has fallen to 0.8%, which I find lower than preferable. With persistent difficulties in credit markets, developing fears regarding further disinflation, and concerns regarding the sustainability of the recovery, we have chosen to maintain the Fed funds rate between 0 and 25 basis points for the last 20 months. Despite our efforts, declines in inflation indicate that the real effective Fed funds rate is increasing slightly. Our recent decision to buy $600 billion worth of treasuries by the second quarter of 2011 is one the committee found necessary to aid the recovery. It is important that we note that we will be analyzing incoming information and do have the ability to adjust the program as needed in pursuit of our dual mandate.
In my judgment, the initiation of the second round of quantitative easing was necessary to reduce the threat of deflation. Nevertheless, I'm still concerned about this risk. As witnessed in Japan, the consequences of entering a deflationary cycle are dire. The economy would stagnate with unemployment at its presently elevated rate, as consumers would not be able to pay down higher real debt burdens, and consumption and investment spending would be postponed. As such, I think we must be ready to maintain our purchases for as long as necessary.
Mr. Stacy, while I understand your concerns with deflation, the continued policy of reinvestment of funds from expiring mortgage-backed securities, accompanied with a second round of quantitative easing, not only prevents our balance sheet from shrinking, but expands it even further. In view of the lower bound on short-term interest rates, these efforts are intended to maintain lower long-term interest rates and a flatter yield curve in order to promote lending, investment, and spending.
On the other hand, it is important to note that we are continuing to work on more clearly defining an exit strategy for when such action becomes necessary. In the last few months, the committee has engaged in testing tools for possible future reserve draining operations. We have successfully conducted small value auctions of term deposits, as well as few small value term reverse repos. Another part of our exit strategy will be to increase interest rate on excess reserve and possibly the federal funds rate.
Mr. Wang, thank you for bringing up our available exit measures. In light of our recent easing, continued testing of these programs and a clearly defined exit strategy are of paramount importance. We now will need to remove even more reserves from the banking system. Reevaluation of the necessity of this easing is also important. Quite frankly, despite Mr. Stacy's concerns, I do not view deflation as a threat, nor do I find strong evidence indicating we are at risk of growth ceasing. In fact, I'm inclined to believe that we're entrenched in a sustainable, albeit weak, recovery.
Turning to aggregate demand, we are already seeing evidence consistent with a normal recovery pattern in the manufacturing sector. Growth in industrial production should continue this quarter, and while it is likely to weaken in the future as inventory adjustments are completed, this slowdown is part of a normal recovery pattern. Additionally, given their profit margins, investment and capital spending should remain consistent with growth. Capacity utilization is even returning to more normal levels, now close to 75%, which, while still low historically, is a significant improvement from the lows reached last year.
But that's only manufacturing. Consumer confidence has fallen from its peak earlier this year, according to the University of Michigan survey, with expectations regarding future conditions being the driving force behind this decline. This is reflective of the uncertainty in the economy currently prevailing regarding the sustainability of the recovery.
Another reason for weak demand and low confidence is the labor market. Slack in the labor market has resulted in wages and salaries rising at a pace less than that of economic growth. Keeping in mind all these factors, it is still too soon to conclude that the risk of further downturn has been averted.
Consumption growth has historically been a driving factor for recoveries, but this recovery has been quite weak in this aspect. Due to the nature of this recession, such a prolonged period of hesitation on consumers' parts is not surprising. As a result of their uncertainty and in response to the shocks endured during the crisis, the saving rate has increased and remained at 6%. This is evidence that consumers are undertaking substantial adjustments to their balance sheets.
The consistent decrease in the debt to disposable income ratio indicates that consumers are adjusting their balance sheet to a more sustainable debt level. It appears that we are returning to a ratio consistent with the growth in the early part of this decade. Nevertheless, it is possible that in response to the crisis, consumers will reduce this ratio further before returning to normal participation in borrowing. Additionally, business investment, which Ms. Chawla found encouraging, has been driven by replacement and updates rather than expanding equipment and technology stock.
Perhaps, but there are encouraging signs elsewhere too. Foreign economic growth in emerging market economies has strengthened further. Continued growth abroad combined with a weakening dollar should increase demand for U.S. goods in the future. Also, carefully conducted policy in response to sovereign debt issues in Europe earlier this year has led to some improvement in financial market conditions abroad, which in turn has aided improvement here as well.
Indeed, the security purchases, which were intended to flatten the yield curve, has resulted in a low rate of return for investors. Interest rate parity clearly suggests downward pressure on future exchange rates due to increasing capital outflow, which has decreased the demand for the dollar and resulted in depreciation. This has and will continue to promote U.S. growth. Export.
The exchange rate channel is one way in which quantitative easing can aid the recovery, but I'd like to draw our attention to another channel. The shift in the holding of traditionally safe assets such as treasuries to riskier assets such as equities should improve access to capital markets for firms. This portfolio balance effect will then make it easier for firms to expand, which in turn could improve labor market conditions.
At the same time, the quantitative easing has pushed up people's expectations of future returns on investment. As a result of this, equity prices have increased since the announcement of our purchase program in early November. This will improve collector values more broadly and could lead to a positive wealth effect.
However, steep declines in housing prices during the recession created a negative wealth effect that we have yet to overcome. Even though the downturn in both prices and residential investment may have ended, both inventories and vacancies remain notably high. Sales of existing homes reached an unprecedented low this summer, and new starts, despite recent increases, remain at a level far below those prior to the downturn. Looking ahead does not give us much reason for optimism either, as permits remain at a level below nearly any in the last 50 years.
In addition to the weakness in housing, weakness persists in the labor market, primarily due to weak final demand and uncertainties regarding future regulations affecting employment costs. Unemployment is unlikely to come down in the short term because of the nature of this balance sheet recession, contributing to a jobless recovery. Furthermore, it is possible that the economy might have changed structurally due to the nature of the financial crisis and the housing market crash. Location and skill mismatch factors may be affecting both the unemployment rate and the duration of unemployment.
Exactly. While I am by no means suggesting that the high level of unemployment is not a concern, I do not find it that surprising. The recent recession was very severe. It's quite logical that there would be some hysteresis. Indicative of this, some estimates of the natural rate have moved up recently, though I for one think that they may not yet have increased enough. In addition to the factors discussed by Mr. Wong, the extension of unemployment compensation from 26 to 99 weeks may decrease the incentive to seek employment, which could lead to possible further increases in the natural rate.
But all the slack cannot be related solely to the changes in incentives. Most estimates suggest that most of the increase in unemployment since the onset of the recession is cyclical in nature, implying that even though the natural rate may have shifted, it does not completely explain the increase in unemployment rate. There's still significant slack in the economy. Despite non-farm payrolls increasing 151,000 in October, the unemployment rate held steady at 9.6% and labor force participation declined.
In the early stages of the recovery, strong productivity growth exacerbated labor market weakness. As the recovery began, firms met increasing demand through worker-enhancing efforts. These efforts seem to have been fully utilized now as productivity growth seems to have peaked already. As the recovery strengthens, we can expect large profit margins to translate into further capital deepening.
Within the Philip curve framework, the aforementioned slack clearly indicates subdued inflation. Perhaps as a result, the University of Michigan survey short-term inflation expectations fell in September, though they have since rebounded. With inflation as already low as it is, declines could lead to further undesirable disinflation. According to 10-year inflation expectations obtained from the survey of professional forecasters, people's long-term inflation expectations have not risen, indicating continued confidence in our ability to withdraw our easing.
Mr. Wong, while long-term expectations may be stable enough, you do not seem to be taking into consideration the rapid increase in the monetary base resulting from our policy of quantitative easing. Despite this, tight credit markets accompanied by depressed demand for credit has resulted in a less than proportional increase in the money supply, indicated by the decreased money multiplier. If and when the money multiplier does increase, though, we will be at a clear risk of inflation.
I'm already concerned about inflation. Suppose that confidence returns rapidly and that supply and demand for loans increases in accordance with the low interest rate environment. The money multiplier, while currently at an abnormally low level, would quickly rise, and we could be caught watching as billions of dollars of reserves rapidly turn over and increase the money supply, leading to inflation. We simply cannot afford to wait until we see signs that this is about to happen. We don't know exactly how quickly our exit strategies will be able to take effect. And we do know that traditional monetary policy works only with a substantial lag. Simply put, we must move preemptively in order to better prepare ourselves for this eventuality.
Mr. McNamara, while I see where you're coming from, our exit strategy has been in development for a long time now. The success of our trials, as well as the increasing number of financial institutions and primary dealers who've become familiar with these facilities, leaves me confident that we could contract the monetary base suitably when it becomes necessary. Further, given the weakness and uncertainty pervading the economy, I think we should continue our policy of quantitative easing until we see a normalization of credit markets that is consistent with our dual mandate.
I think that stopping our purchase program prior to our suggested timeline would only be justified if we have evidence of increased lending activity. Such increased lending would indicate that economic growth is returning to a pace that would significantly reduce existing slack in the economy.
But our asset purchases are unlikely to have the same effect as the first round of easing. The primary reason that easing worked was the lack of liquidity in financial markets. Now, though, businesses are much closer to being deleveraged. Injecting more liquidity just won't have the same impact. Furthermore, I do not see the need for more support for growth. Even with some passive tightening, as has been noted, I think that policy remains more than sufficiently accommodative enough to continue to promote economic growth.
Are you seriously proposing we halt our purchases?
I'm simply questioning the need for quantitative easing. In my opinion, the risk of such extensive purchases outweighs the marginal benefits that they might provide. We are likely to see only a small improvement in growth as a result of the easing. But by expanding the monetary base another $600 billion, we risk not only unwanted inflation, but increased fears of permanent debt monetization. In light of longer-term budgetary concerns, this could lead to an undesirable increase in inflation expectations.
But Mr. McNamara, continuing quantitative easing will not only affect the economy through the lending channel. I urge you to recall the exchange rate and the portfolio balance channels we discussed earlier. Also, as a result of the cross-correlation of asset prices, continued quantitative easing will increase the value of collateral and assets. However, we still have to be very careful in determining whether or not we should back off these purchases, since we have much less experience in judging the economic effect and lack of this policy instrument.
It is time to make our policy decision. Given our discussion, I think it would be prudent to maintain our policy rate at 0 to 25 basis points and continue to reinvest maturing securities into treasuries in order to maintain lower, longer-term interest rates. Also, we should continue as planned with our December purchase of $75 billion of treasuries in order to provide additional support to the recovery.
Our initial purchase of assets as part of the second round of quantitative easing has resulted in a slight improvement in credit conditions by decreasing interest rates and pushing up asset prices. Nevertheless, I also think that the interest rate should be maintained because there is still slack in the economy that is not completely accounted for by structural shifts. The slack is also reflected in weak confidence and slow wage growth, which certainly indicates continued risk to expansion of economic growth. As a result, I support your view, Mr. Fines.
Given the discussion, I think concerns have clearly been noted regarding the sustainability of the recovery. Continuing the trash-free purchase program is the most effective way of addressing these concerns at this time. Removing the accommodation that the current policy provides is simply too risky given the current economic environment.
With unemployment at its presently elevated rate and an inflationary outlook threateningly close to deflation, I'm of the opinion that we should maintain our present expansionary stance and continue our large-scale asset purchase program.
I disagree regarding our primary concerns. I think undertaking a second round of easing may not have been optimal policy. To correct this, I would advocate that we begin to taper off our purchases, though with great care not to disrupt markets too much in the process. Furthermore, I think our communication must clearly indicate that our next move will be to begin removing accommodating policy, though perhaps not immediately following the conclusion of our purchases. Even with some increases, our policy rate would remain in an unprecedentedly expansionary stance.
Well, it appears that we generally agreed to maintain the target federal funds rate at 0 to 25 basis points and continue quantitative easing. I would now like to move on to a discussion of our press release. Are there modifications that anyone would like to propose?
I think we should clarify our conditionality regarding the continuation of the quantitative easing program. In particular, I think it may be beneficial to specify what information we are monitoring so that market participants can adjust their expectations accordingly.
Mr. Wang is right. There could be some benefit to such specification. Perhaps we should edit the phrase to, the committee will regularly review the pace of its security purchases and the overall size of the asset purchase program in light of incoming information regarding economic growth, inflation, and changes in the labor market, and will adjust the program as needed to best foster maximum employment and price stability. Such references will serve to increase the transparency of our policy and reduce undesirable shifts in market expectations.
But such specifics may tie our hands. It's possible that improvements in economic activity and inflation may arise as a result of expectations of continued easing. Clearly indicating what we're monitoring may lead to an undesirable situation in which we have signaled that we would discontinue our purchase, but in fact we may want to continue in order to prevent any resulting adverse shock.
This is certainly an important language decision. I do see the potential for benefits, but Mr. Stacy is correct to note that there are some disadvantages as well. Mr. McNamara, what are your thoughts regarding this proposal?
I think that the risks Mr. Stacy identifies are very real. However, I think such clarity may tie our hands in the other direction as well. If lending activity begins to accelerate, we would then need to stop our purchases and perhaps even begin withdrawing liquidity. But if this happens without significant improvements in growth and employment, this may run counter to market expectations, and this could lead to some kind of adverse shock.
The detail that Ms. Chala's phrase provides is simply too extensive at this time. I think that quantitative easing will remain necessary for the next few months at the very least. As such, indicating what we're monitoring with regard to discontinuing easing might imply that we're much closer to such a decision than we actually are.
I think Ms. Chala made an interesting proposal. However, I'm inclined to agree with Mr. Stacy and Mr. McNamara that it is too restrictive at this time. We should certainly continue this discussion at our next meeting. Is there anything else we need to address?
I think we should consider removing the phrase exceptionally low levels and signaling to markets that our next move will be to begin increasing the federal funds rate. Combined with my proposed winding down of purchases, I think that this would most effectively communicate to the public what monetary policy needs to do in order to minimize the risks to inflation going forward.
I would be quite opposed to that. Any signaling of a policy tightening could jeopardize the recovery.
Mr. Stacy is right. Therefore, I think our general agreement is that the language is effective as is, and that our December purchase should proceed as planned. Given incoming data, I believe purchases are likely to continue going forward. Does anyone have any further suggestions? With that decision reached, I will now notify New York of our decision to hold the target federal funds rate at its current level of 0 to 25 basis points and have our statement released.
Thank you.
Thank you for that presentation. Really appreciate your time and interest in this subject, especially your semester's drawing to an end. Lots of stuff is going on, and you've made time for this, so we thank you very much. I'd like to start off, and any of you can answer this, even though you in particular were talking about inflation expectations in the talk. Do you happen to know the latest reading on short-run inflation expectations?
Short run, 1 year inflation expectation, I believe, is around 3%, and the 5 year is about 2.8%.
Yeah, so 3%, and that's a lot higher than inflation has been recently. Should we take those expectations literally, that the public expects an immediate acceleration in the CPI?
I think what we should looking at is a tendency rather than a sudden increase, sudden rebound in October. I think the recent rebound of the short-term inflation expectation is mainly because of the announcements for QE2. So this inflation expectation will only be transferred to inflation if we do see a tendency of increasing inflation expectations.
I think it's also important to note that at least the short-term inflation expectations that we're referencing here are from the University of Michigan survey. And historically, short-term inflation expectations around 3 to 3.5%, according to this survey, have been consistent with inflation around the 2% level, which is in our comfort zone. So it's possible that there could be measurement discrepancies, possibly influenced by the fact that consumers may weight their expectations very heavily in anticipation of either oil price shocks or things that do not necessarily influence the aggregate inflation rate uniformly. And then, in addition, it's also possible that consumers may take a slightly more pessimistic outlook in order to maintain a well-adjusted balance sheet going forward.
Okay, very good. Suppose that we thought that there was a full percentage point of bias in that measure, so that correcting for that would still leave 2% expected inflation. If that were the case, would that mean we don't have to worry about deflation anymore?
Personally, I think that with expectations anchored at a level that we feel is consistent with price stability, I think definitely outright deflation seems highly unlikely going forward, even in the next few months. It's important to note that while inflation is very low compared to where it has been recently, we have inflation that's consistent with what gave us price stability in the 1950s and seemed to be sustainable at that point in time, as well as we still have nearly a full percentage point of buffer before we actually hit zero inflation and that threshold point where we would cross into a deflationary spiral potentially.
Although, I mean, our position with regard to aggregate demand and slack suggests that even though inflation expectations might be there, we do need to be concerned about the potential for deflation.
Okay, thank you.
So the Federal Reserve, the conduct and goals of monetary policy have been in the press a lot more recently than they had been in, the prior 10 years or so. Lots of discussion about QE2 and whatnot. One thing that has come up a few times in the press is you get people suggesting that maybe we should chuck all this and just go back on the gold standard. I'm wondering what your views of that possible change in policy would be, and if you think there's any merit in it.
I think that right now, if we abandoned any fiat currency for a gold standard, it would probably result in policy being excessively tight at the moment. And given where we stand, it would be important, I think, that we maintain an expansionary stance.
There's also been recent research over the past 20 years showing that some of the commonly cited benefits of a gold standard may not actually exist in the economy. One commonly cited benefit is that it would reduce the cost of capital in the economy, and it seems unlikely that this is actually the case. According to recent studies, they've found that, in fact, capital costs are not statistically different than they would be under a fiat currency system. I also think that such a drastic shock at a tenuous point in an economic recovery would possibly be ill-timed at the moment.
The other question I had was about the discussion about housing. One of you, I forget which one, noted that there's been a lot of weakness in the housing sector, particularly in the last few months, that we haven't started to see much of a recovery. How much of that do you think is due to temporary factors, sort of unwinding of tax benefits, or of sort of foreclosure, foreclosure, all the documentation issues related to foreclosures? What do you think? Do you think those temporary factors are having an effect on the housing market?
I believe that they're definitely having an effect on the housing market, but I think that, like we stated in the presentation, that with the economic conditions how they've been, that it's not just because of the tax breaks and the foreclosures happening. I think it's a trend that we're going to see a little longer.
And just to add to that, the new constructions have also been at an all-time low and has been almost flat this year. And so despite construction not increasing, the supply of houses not increasing, the prices have still been low, which means that the demand for housing is not there, irrespective of the tax benefits and various other uncertainties in the market.
It's definitely important to remember that one of the causes of the recent financial crisis and recession was a collapse of an asset bubble in the housing market. And what this has done is it's created a large overhang of the supply of homes, as well as most likely households may have reached a head sort of during the asset bubble when prices were appreciating rapidly and they were able to extract large amounts of equity from their already existing homes. And it's quite possible that purchases were pulled forward even then, and that demand now is not here with prices no longer appreciating and equity no longer available for use in further purchases.
Thank you.
Let me turn my attention a little bit to the labor markets. You talked about that there might be an increase in structural unemployment. What measures would you look at to show that there is an increase in structural unemployment?
The upward sloping of the Beveridge curve, which shows there is increase in structural factors in unemployment.
Historically, a flat to upward sloping Beveridge curve, which is the relationship between vacancies and the unemployment rate, indicates that essentially there are vacancies, but they aren't being filled, which would be an indication that there's a mismatch between the vacancies and the available workers. And this seems somewhat logical given the recent recession that there would be some of this because in particular the construction industry was hit extremely hard, and it may be very difficult for the extreme amount of workers laid off in this industry to find other jobs in a more timely fashion, as would maybe happen in other downturns.
Let me turn my attention to my other hat as an academic or educator. So, having participated in the College Fed Challenge now, what do you think is the most important thing you've learned?
I knew near nothing about the Federal Reserve until I started this class and started working with all of us. And now I know so much more about the economy and what I need to look at as a citizen to see what decisions need to be made and why you're making the decisions you're making. I understand now inflation is a huge concern with the Federal Reserve and why it's a concern and how theoretically it plays into the economy as a whole.
I think one of the biggest things that I've learned is that there are upside and downside risks to every decision that has been taken and that has to be taken going forward. And what the Federal Reserve has to do is weigh the costs and the benefits and take the best possible decision given the current circumstances. And that decision might be hard in a lot of situations.
And
Some commentators have stated that QE2 is tantamount to currency manipulation. Do you think that's a fair criticism?
I don't think so, because given the dual mandate of our Federal Reserve and the initial goal for quantitative easing is to increase inflation expectation to our comfort zone and to provide additional drive to the recovery in order to provide more additional recovery in the labor market. So exchange rate is not our primary concern.
I think so. One of the goals of the asset purchase program was to lower longer-term interest rates, and it just so happens that a devaluation of the dollar will happen. However, it's important to note that should the lowering of interest rates have a stimulatory effect on the economy, the boost in aggregate demand should buoy the dollar up again. and so it isn't. I don't think it's necessarily should be considered as straight currency devaluation.
Furthermore, I think that improving aggregate demand in the U.S. will have beneficial effects for the global economy as a whole, given the interconnectedness. With growth increasing here, and perhaps if we can return ourselves to stability, we generally have a negative net exports in the economy, and it's quite possible that our demand for foreign goods and services would start to improve significantly as the economy recovers here and consumers return to more normal spending patterns.
Do you really think the problem is firms have problems accessing capital, given how much cash they have on hand? I mean, lower rates, right? Firms are supposed to borrow more money easily, but they're sitting on a lot of cash. So do you think QE2 will really influence firms to make more investment?
In my understanding, the big firms who has the cash is those big firms with large profit. Who provides the most jobs now is the small firms, and most of them doesn't have the access to the capital. And I think quantitative easing is an effective way of shift the attention to traditional safe assets such as treasuries to riskier assets. So this will provide resources for the small firms to access to the fund and invest and provide jobs.
Personally, though, I think that the effect is likely to be at the margins only. I mean, you're very correct to note that there is an excessive amount of excess reserves and cash from large profit margins over the course of much of the last 2 years for businesses. And I think that the problem stems less from a lack of access to credit, as we've noted some improvements in credit availability at least, although not demand for credit. It seems that firms are mostly uncertain about their prospects going forward and at the moment unwilling to take that next step to actually invest the capital.
How worried should we be about commodity prices, and how likely is that to feed through into core inflation?
I think that pass-through from commodity prices is unlikely at the moment. While there has been a significant run-up in particularly gold and silver, they make up a relatively small market in the world economy, and there are simply not enough investors in these commodities for these prices to significantly affect prices of consumer goods as a whole, really.
I think I remember hearing the phrase comfort zone on inflation mentioned in the presentation, but I don't remember a specific number. Can you give what specific number the Open Market Committee might have for inflation? And do you think that's appropriate, or would you suggest something better?
Our current, we would guess, is 1.5 to 2% for the inflation current comfort zone. And
I think should the that comfort zone be raised, this could lead to an increase in inflation expectations, which would increase the effectiveness of the zero Fed funds rate at the moment and could stimulate the economy further.
So you think an increase in inflation expectations would be a good thing?
For now.
We also need to keep in mind that an increase in this comfort zone would result in more volatility because at a higher level of inflation, you do see higher volatility with the inflation rates.
However, I think increasing inflation reduces the real debt burden, which is good, which will
help us right now.
Increase the consumption.
On the other hand, I think that increases in inflation expectations are a somewhat dangerous thing to play with. It took a very, very long time after the Great Inflation in the 70s to reestablish the Federal Reserve's credibility in their ability to maintain price stability in the economy. And messing around with inflation expectations, changing that level at which they're anchored, is dangerous because you would have to first unhinge them from the level that they're anchored at the moment in order to reset them somewhere else. And it's quite possible, there's a risk that you could lose control sort of where they are anchored, and the run-up could exceed what may provide some temporary benefits. Also, increase in the sacrifice ratio as a result of the establishment of credibility means that reductions after the fact, if we increase inflation expectations, could be very costly at that point in time.
You need to stop. Thank you.